We will be discussing the important dividend theories in the module of business finance, that is module number 4 as per the syllabus. We are moving right to the theory part. Actually, there are two schools of thought in dividend decision making. The one school of thought says dividend decision does not affect the shareholders' wealth. So, even if you give dividend, the investors will be happy only for a moment, but that is not going to create any wealth for the investors. That is one school of thought, which is known as the theory of irrelevance, because the dividend decision does not affect the shareholders' wealth, the theory of irrelevance. And the second school of thought is just opposite to this. Dividend decision affects the value of the firm. So, we say it is theory of relevance. So, these are the two schools of thought, theory of irrelevance and theory of irrelevance. Theory of irrelevance and theory of relevance. Usually we start with the irrelevance theories, and we have two theories in each category. The irrelevance concept of dividend, there are two theories here, the residual approach and the model. So, you have to focus on this part, which is model. The irrelevance concept connected with or is explained through residual approach and model, while the relevance concept of dividend is explained through two models. One is Walter's model and Gordon's model. This part is much more important than the approach, because approach you can see in capital structure theories also. So, what is residual approach? The term residual means keeping back. This theory regards dividend decision merely as a part of financing decision, because the earnings available may be retained in the business for reinvestment. So, residual approach says you did not give the dividend. Rather than giving or distributing that profit, you invest that again in a new business or in the existing business to generate more revenue. So, why don't you reinvest? And you might have heard about Warren Buffett, the world famous investor. He says a good company should never give money in terms of dividend. You should actually reinvest in the business, and he is not invested or he is not supporting dividend paying companies as such. So, we could say that he actually practices a theory of irrelevance, right. So, reinvestment of profit is important in residual approach, but if the funds are not required in the business, they may be distributed as dividends. So, this theory also says if you have no other option, you have to distribute the dividend. So, in a way, if a company distributes dividend, that means they do not have any opportunity to reinvest that money. Thus, decision or to pay dividends to retain the earnings may be taken as a residual decision. A firm should retain or pay dividends. That is what the conclusion of this theory. There is no mathematical equations required in this. The next model in the theory of irrelevance is model. The splitting of earnings between retention and dividend. So, either you can retain the profit or give out as dividend. The splitting of earnings between retention and dividend may be in any manner the firm likes, does not affect the value of the firm. So, it is up to the firm to decide on the payout ratio or the retention ratio, and that is the core decision of the firm. Nobody is going to balance that, and it does not affect the value of the firm. That is again an irrelevance theory. What is the argument of Whatever increase in the value of the firm resulting from the payment of dividend will be exactly offset by the decline in the market price of the shares. So, if there is an increase in the value of the firm, when the firm says like we are going to issue dividend, people will start buying the share, but immediately after the post or the record date as per the share market terminology, the next day itself the share price will fall by the same amount. A decline in the market price of the share because of external financing. Why external financing is, if they give out the profit in terms of dividend, what happens is they have to go in for debt, they have to go for external source of finance for funding new projects, which will again reduce the value of the firm, and there will be no change in the total wealth of the shareholders. So, this theory is actually connecting the market price of the share and the dividend decision. Whatever you are paying as dividend will be there, that is declining in the value of shares. External financing will result in the increase of number of shares and payment of interest charges, resulting in a fall of earnings. So, external financing could be either done through equity or debt. If in case of equity, what happens when the number of equity increases, shares increases, the earning per share comes down. If you take debt as an external source of finance, you have to pay interest. So, both these possibilities come into a, and what happens is, end of the day, you do not have any benefit after paying the dividend. The market price of the share in the beginning of the period will be equal to the present value of the dividends paid at the end of the period plus the market price of the shares at the end of the time. So, you are connecting the market price of the share with the present value of the dividend. For example, a company whose share is 100 today, this company regularly pays dividends. So, after 1 year, the company is expected to give a dividend of say 2 rupees. So, naturally, that 2 rupees present value will be discounted today. That 2 rupees present value will be discounted today. So, the share will not trade at rupees 100, it will trade at a value less than 100, even though it has a valuation of 100 because of this dividend policy. That is what is explained in this. And the equation you just need to memorize. They won't ask problems, I hope. Just need to by heart P0 equal to D1 plus P1 divided by 1 plus KE. Usual terminologies. PO stands for market price per share at the beginning of the time. Dividend to be received at the end of the time. P1 is the core KE, you know, its cost of equity capital, and P1 is the market price per share at the end of the time. So, you have got 4 variables in this. P0, the current market price, is D1, the next year's dividend, plus P1, next year's expected price, divided by 1 plus KE, which is the cost of equity capital. Higher the profitability of the business, higher will be the value of the dividend, and the value of the firm also increases with this. This is the message conveyed by the second school of thought, which is the relevance concept. This concept is explained through 2 models, which is the Walter's approach and Gordon's. We will take you through the Walter's approach first. It explains the relationship between IRR, the internal rate of return, and the cost of capital. So, there are 3 cases in this. If IRR is greater than K, the internal rate of return is greater than cost of capital. It means the firm is actually growing. This is a growth business. So, what the firm must do? They must reinvest the profit in new business opportunities and create wealth for the company. So, that is the implication. If IRR is greater than K, you have to reinvest the amount and increase the value of the company. So, the dividend payout ratio will be 0. Remember, when IRR is greater than cost of equity, the payout is equal to 0. That is the first assumption in this. In the second situation, that IRR is less than K, this means the firm is not growing. The cost of equity is higher than the return. So, the firm is actually losing money. In that case, the firm must pay out 100% profit. 100% has to be given as dividend. So, the payout ratio must be 100%. Third case, when IRR is equal to the cost of equity. In this case, it is up to the firm to decide. The payout ratio will not affect the value of the firm. The dividend payout ratio has no impact on the value of the firm. So, at this point, this theory becomes almost equivalent to the theory of irrelevance, because dividend payout ratio has got no impact in creating the value of the firm. According to this Gordon's approach, the market value of the shares is equal to the present value of future streams of dividends. The present value actually is reflected in the market price of the share. The future expectation of dividends has got an impact on the present market price of shares. There are 3 implications in this model. When R is greater than K, the internal rate of return is greater than the cost of equity capital, the price per share increases because the dividend payout ratio decreases or retention ratio increases. So, what does that imply is the growth firm should distribute smaller dividends and should retain maximum earnings. So, when R is greater than K, the firm is in the growing category. So, it is better not to pay much dividend, you can retain more, retention ratio increases, in a way the payout ratio decreases. So, what happens is the price per share increases. This is the first implication. The second implication is when R equals K. When R equals K, the price per share remains unchanged and it is not affected by the dividend policy. So, here internal rate of return and cost of capital are equal. The firm cannot be categorized as either growth or in a non-growth stage. So, for a normal firm there is no optimum dividend payout. So, such firms are classified as normal firms and there is nothing like an optimum payout ratio and it is not going to affect your wealth. The dividend payout ratio won't affect the market value of the shares. The third implication, when R is less than K, what happens again, the price per share increases because the retention ratio decreases and dividend payout ratio increases. So, the company is paying out dividends, paying more dividends. So, naturally people want that money back. So, the price will grow up. So, in first case and the third implication, the price of the share increases. In the second case where R is equal to K, the price has now changed. So, when R is less than K, the price per share increases because the retention ratio decreases or the dividend payout increases. Thus, shareholders of declining firm stand to gain if firm distributes the earnings. For such firm, the payout would be 100% or the retention should be 0%. So, almost similar with Walter approach, nothing much different. But one more approach could be learned, which is known as Gordon's revised model. We have seen questions from this part. The basic assumption of Gordon's basic valuation model was that cost of capital remains constant for a firm. So, we discussed Gordon's approach on the assumption that the cost of capital is a constant, only the rate of return changes, but here the interest rates keep changing. So, the cost of capital remaining constant for a firm is not true, it keeps changing in actual practice. So, he has created a Gordon's revised model. The reason is the cost of capital keeps varying. So, he revised his basic model to consider two things, the risk and uncertainty. Future risk is considered here. In the revised model, he suggested that even when R is equal to K, the dividend policy affects the value of shares on account of uncertainty of future. Important point. Previously, in the second implication, we said when R is equal to K, there is no effect on the value of the shares, but he says now, but due to the change in cost of capital, there will be a fluctuation in the price, because the reason is after 1 year somebody says that this firm will grow to such an extent, but there is a huge risk, anything can happen, it's COVID and all the predictions have gone wrong for the profitability of the company. It is a systematic risk. The business has not the risk of the business, but the system has gone into trouble. Such uncertainty has to be accounted to in revised Gordon model. So, he said that it is better you give some dividend to the investors once in a while to make them happy, because future you may not be able to pay dividend. So, therefore, there is a twofold assumption. Investors are risk averse, that is true, and they put a premium on a certain return and discount uncertain returns, because uncertain returns they are not happy even if it is in growing stage. If they get some value as dividend, they will be happy. So, that led to an approach called bird in hand argument. The value of rupee of dividend income is more than the value of rupee of capital gain, because you are expecting value to increase in the share maybe after 1 year, 2 year, but some uncertain events happen, this may not happen, but if you get some in cash today, that is better than expecting or waiting for the future. So, that is called the bird in hand argument, which is connected with the Gordon's model. You have to remember, bird in hand argument is connected with Gordon's approach. And last, we will just say one more point, which is often referred as myopic vision in dividend theory. Too stocks of identical earnings record prospects, but one paying a larger dividend than the other. The former will command a higher price merely because shareholders prefer present value to future value. So, this is also a continuation of what we just saw told in the bird in hand argument, because two identical stocks, the one which pays larger dividend today assumes a higher price only because of the reason that there is certainty in what is being received. So, that may be true, may not be true, because we are risk averse, and that vision is called myopic vision, again connected with Gordon's approach. So, we will take you through the NTA questions now. We will be discussing 3 questions. Question number 1, which of the following statements are correct? Dividend payout ratio refers to that portion of total earnings which is distributed among equity shareholders of the company. Sure, dividend payout ratio is what is being defined here. Bird in hand argument is connected with Gordon's model. Yeah, we just discussed this concept. M&M model suggests that dividend payment is very relevant for the firm. Wrong. M&M model assumes the dividend is irrelevant. Walter's model suggests that dividend payment does not affect the market price of the share. That is also wrong. C and D actually are wrong. You can just go through the previous slides. The answer is A and B are true. So, the answer will be option A, B. The next is a match the following question. On the left side you have net income approach, Gordon model, internal rate of return and reorder level. Net income approach is part of capital structure theories. We have already uploaded a few videos in the platform. Gordon model, just learned, it's a dividend decision theory. So, we can connect Gordon model with dividend theory, which is B4. And going through the options, you have 2 options left, B4 2 options left. And net income approach is A3, both the options. So, it is capital structure theory. Internal rate of return is a part of capital budgeting. Again, please go through the videos we have uploaded. Internal rate of return is C2 and reorder level is part of inventory management. So, we can easily connect the left side and the left list 2. So, the answer is option B, A3, B4, C2 and D1. That gives your option B as the right answer. The last question in this video, which of the following statements are false? A question was there for NTA December 2018. Having learned a few statements, we will start from the last. Walter's model suggests that dividend payment does not affect the market price of the share. That is wrong, because Walter and Gordon believes in theory of relevance. Here it is wrong. So, 4 is wrong. Every company should follow the policy of low dividend payment. Not at all, because it depends on the company, it depends on the relation between internal rate of return and cost of capital. So, 3 is wrong. 3 and 4 are wrong. What about 2? Dividends are paid out of profits and therefore do not affect the liquidity position of the firm. That is also wrong, because dividend is paid after paying the tax, net profit after tax, from that value we pay the dividend. So, it affects the dividend, the cash flow, because rather than giving dividend you can actually place that money in the reserves, right. So, 2 also false. So, 2, 3 and 4 are wrong. Just go through the options. You have 2 options left, 1 and B and C. So, to come back to the first, capital profits can never be distributed as dividends to shareholders. That is true. Capital profits are something which you get by selling of your assets. That cannot be. Only operational profits could be distributed as dividend. So, 1 is true. So, 2, 3 and 4 is the right answer. We have are false. So, the right answer would be option C, 2, 3 and 4.